Okay, so my plan for the day, if time allows, I want us to look at a question, yeah, published accounts. Then also we look at a question, yeah, consolidation. Then Tozona, if we still have more time, we can talk about the ratios. But let's start with the published accounts question. So for the published accounts question, the main area that we just want to look at is how we then apply those standards to the question. Because now question a published accounts, in OH button needs the various standards on one question. So the one that we did last time, it was adjusting the profit, which is good. But this one, it's saying we should prepare prepare the consolidated financial position. Is it the one that I wanted? Okay, now let me check. I wanted us to start with the income statement. Let me check for a question with the income statement. So we'll do the consolidated statement of financial position after this one. I want us to start with the consolidated income statement. Okay, so the question is saying, this is now part C of the question. Prepare the statement of profit or loss and other comprehensive income for Gibraltar Company for the year ended 31 October 20x3. So always take note, our year is ending when. So when you're answering the FR questions, the dates are very important because our year end, when we see December, as we are used to. So please take note of that, because any adjustments, such as if it's depreciation or other adjustments that might need to be made, if we are to buy an asset at halfway through the year, then the depreciation shouldn't be for the whole year. We have to apportion. So in your time apportioning, we need to take note of the debts. So the first question is just preparation of the income statement. The second question is saying, come up with a statement of changes in equity. Then lastly, the question is saying reinstate the basic EPS. So that's IAS 33. Restate the basic EPS at 31 October 20x2 to take account of the rights issue made during the year. So now let's go to the question. So we are given the trial balance. We are given the trial balance of the G company. And after the trial balance, we have the additional information. So the first additional information is saying, in October 20x3, G company received 350 from a customer for arranging for the provision of maintenance service. This has been recorded as revenue. G company does not provide maintenance services itself, but instead it uses third party. G company retains 12% of the amount received as commission and pays the balance to third party 1 month in arrears. So which standard is this one? This is IFRS 15 revenue. So this one is affecting IFRS 15 revenue. So under IFRS 15, we said that you recognize a revenue after the performance obligation has been met. And for you to recognize revenue, you must be the principal. In this case, this is a principal-agent relationship that we are looking at. So if you are an agent, like in this case where you are selling goods that do not belong to you, so if you're an agent, what you only record in your books is the commission. You don't record all the amount in the sales, but we account only for the commission. So on the question, what are they saying? So in October 2023, G Company received 350 from a customer for arranging for the provision for maintenance services. This has been recorded as revenue. So that one is wrong. Recording the whole amount as revenue is wrong. Why? Because we are acting as an agent. So if you're acting as an agent, what you need to record as revenue is only your commission. So we need the income statement. So that's part A. So part A, the question was saying prepare the income statement. So let's just say income statement. So the income statement for G Company. I'll just shorten that. So the income statement for G Company, it starts with the revenue. So for our revenue, we are given the original revenue in the trial balance. The revenue in the trial balance that we started with is we started with the revenue of 3765. Or we can just do this. So revenue, then working one. So revenue. So let's come below here and work out our revenue. So for our revenue, we have as per trial balance. So from the trial balance, the revenue we have been given is 3765,505. So that's the revenue we have been given as the trial balance. Then we are told that, let's now go to the additional information. We are told that we received revenue of 350,000 from a customer for arranging the provision for maintenance services. This has been recorded as revenue. So they've recorded the 350 as revenue. And the statement is saying that Gilberta, the last part, Gilberta retains 12% of the amount as commission. So it means that they've included revenue that is not theirs. So we can then say adjustment, or we can say, oh, what's happening here? Okay. So adjustment. So we need to make an adjustment to the revenue that they recorded. So what adjustment are we going to make? So ours was supposed to be only 12%. But we have recorded the whole of the 350 as our revenue. So the adjustment that we have to make is for the other 88% revenue that we recorded. So the 88% is not supposed to be part of the revenue. So we are going to say times 88%. The 12%, yes, we were allowed to include it. But in this case, we included all of it, all of the revenue. So the amount that we included that is not part of the revenue, we are supposed to exclude that. So times 88%. So this one is to be removed. On what basis? Because this one is not ours. We are going to submit it to the principal. What we record as revenue is our revenue only. So hopefully there is no other adjustment on revenue. So if we are to come across any other adjustment for revenue, we can always make an adjustment there. So we can, or let's use this column. Let's widen it up. So our revenue, so that's our revenue. Then from the revenue, oh, it's the wrong column. So from the revenue, we move on to the cost of sales. But if we are to come across any adjustment for revenue, we would again come back to this working and make that adjustment. So let's read the next additional information. So for the first additional information, I think the impact only is on revenue. So that impact is on the amount for revenue recorded. The year-end inventory count was performed a day early on 30 October. The year is ending the last day of October. And the question is saying the year-end inventory was performed a day early. Then on 30 October, it was, correctly recorded in the drafted trial balance. On 31 October, G Company made sales of 12,035, which were also correctly recorded. However, inventory records were not updated. G Company applies a markup of 30% on these goods. So from what I'm hearing, the inventory count, it was done a day before. So we counted inventory 30 October, and our year is ending 31 October. So after we had counted inventory, we later made sales. So there's a cutoff issue here. So we later made sales. So it means the amount we want it needed to be adjusted. The good part, they are saying this one was taken into account myself, so we don't adjust the sales. The statement is saying which were correctly recorded in sales, but where is the issue now? It means in the inventory records, it was not adjusted, because the question is saying the inventory records were not updated. So our closing inventory in this case would be overstated. Why? Because we included the inventory which we sold on the 31st of October. So we need to adjust the closing inventory. And if we are adjusting the closing inventory is an item of cost of sales. Closing inventory is an item of cost of sales. So let's have our working two, cost of sales. Good part about Excel is if you come across any adjustment that you later need to make, you can just easily make the adjustment. So the cost of sales we have as the trial balance. So the cost of sales as per trial balance is 2446577. 2446577. So if we reduce closing stock, if we are reducing inventory, so if we are actually reducing inventory, what's the impact on cost of sales? So if you are reducing closing inventory, it tends to increase cost of sales. Remember, closing inventory reduces cost of sales. We say less closing stock. So if we are reducing the closing stock, it actually increases the cost of sales. So inventory adjustment. So the inventory adjustment, tine magoods atakatengesa, and magoods aya anenge akarekodwa mu-inventory at cost. Inventory record at the lower of cost. So if these goods were sold, we have to reduce our inventory, but from the inventory we reduce at cost. Of course, the selling price we add at selling price, but from our inventory we reduce at cost. So we are given the selling price of the goods, we have to convert that to cost. So we're given the selling price and markup. If you have the selling price, remember, to get to cost, selling price, you remove margin, not markup. So from the selling price to get to cost, you remove the margin, not markup. So if our let me just work out quickly the margin here. So if our markup is 30%, it means our margin is 30 over 130. That's the margin. 30 over 130 times 12035. 12035. So this amount here is the profit. So we want the cost. So to get the cost, we say the selling price 2035 minus the profit. So there are different ways of getting to the answer, but one of the ways is to just first of all work out your profit, then you remove the profit. If you remove the profit, you then get your cost. So you can first work out the profit, you remove the profit. So if you remove the profit, you get the cost. Let's move on. Just a moment. Need to check for some. Okay, let's proceed. Let me move that. Okay, so from there, we then add up. So from there, we then add up. So that would be the cost of sales figure. That would be our cost of sales figure. So for our cost of sales figure, if we have nothing else affecting cost of sales, we are going to just put that amount. For cost of sales, we're just going to put that amount. But if we come across any adjustment that needs cost of sales, we'll come back to this calculation. Then let's move on. Just trying to figure out where I'm forgetting where you get the where I can remove the decimals there. It's okay. Let's move on. I'll check that later. Let's move on. So from that, then add up the two. So from the cost of sales, we move. But always remember, if we come across any adjustment, that might need us to go back. We'll go back and adjust those. So from adjustment number 2, we are told about inventory. So the year-end inventory count was performed a day early on 30 October 2023 and was correctly recorded in the draft trial balance on 30 October 2023. Made sales of that which were correctly recorded. However, the inventory records were not updated. So I think the effect there is just on inventory records which were not updated. So item number 3, during the year end 31 October 2023, one of the fair value through profit and loss investments. So take note, if you, that's financial instruments. So if you have made an investment in financial instrument, it can be classified as fair value through profit and loss or fair value through other comprehensive income. So the item number 3 is about investment in financial instruments. It's on investments in financial instruments. So what is the question saying? During the year ended 31 October 2023, one of the fair value through profit and loss investments, which had a carrying amount of 62,000, was sold for 59,000. Okay, so the investment was sold for 59,000. So if it's an investment through profit and loss, fair value through profit and loss, remember any fair value gains, we take them to profit and loss. Any fair value changes. The proceeds have been deducted from the year. The proceeds have been deducted from the year-end balance. The proceeds have been deducted from the year-end balance of these investments. However, any gains or loss on disposal should have been recorded in the expense. Let me read again. During the year 31 October, one of the fair value through profit and loss investments, which had a carrying amount of 62,000. So it had a carrying amount of 62,000. It was sold for 59,000. So 59,000 is the sale proceed. This is what we got from the disposal. But in our books, it was being carried at 62,000. The proceeds have been deducted from the year-end balance of the investment. There's an error there, rather, or we can't say an error, but because if we sell an asset from the carrying amount of an asset, we don't remove the sale proceed on. So let's check this investment through the profit and loss. Then I rephrase what I'm hearing. So the fair value through profit and loss, the investment, fair value through other comprehensive income investment fair value through profit and loss. So they are saying the carrying amount is 178,400. But when they sold the investment, what they only deducted is the sale proceed. This investment had a carrying amount of what? If you go to the item number 3, the investment had a carrying amount of 62,000. But the statement is saying they only deducted, the statement is saying the proceeds have been deducted. The proceeds have been deducted from the year-end balance of these investments. However, any gains or losses on disposal should have been recorded. Should have, it means this was not recorded. Should have been recorded in admin expenses. So the gain or loss should have been recorded. So it means it was not recorded. The remaining investment in this classification had a fair value of 184,300. So that's the fair value of the remaining investments at 31 October 2023, which still needs to be recognized. Any gains or loss on revaluation should be recorded in other income. So that's the reason why I actually, when I was browsing through, I like the question because of the investment in financial instruments. So we do need to go through this one together. So working 3. So we can say investment, then this is fair value through profit and loss. Fair value through profit and loss. So that's our first investment we are dealing with here. So for the investment, for our working 3 investment, why is it failing to? Okay, anyway, let's move on. So for our investment, the first issue I noted, which affects our income statement, is the profit on, they are saying the proceeds have been deducted from the year-end balance of this investment. However, any gain or loss on disposal should have been recorded in admin expenses. So the gain on disposal or loss on disposal should have been recorded in admin expenses. So in our admin expenses, so maybe the narration should have been admin expenses. So for admin expenses, how much should we transfer to the admin expenses? Because it was sold for 59 when it had a carrying amount of 62. So they did not record the gain or loss on disposal. So it means for our gain or loss on disposal, we are going to say that 62,000 minus 59. In fact, it had carrying amount of 62, but was sold for 52. So it's a loss on disposal. So there is a loss of 3,000. Let me just write the amount. So there is actually a loss on disposal of 3,000 because in our books, our investment is an asset. It had a carrying amount of 62. We sold it for 59. We made a loss. So this one should be treated, the question is saying should have been recorded as an admin expense. So let me just check the expenses here. So from the cost of sales, we then now move to the expenses. So our expenses, we can start with the admin expenses. So our admin expenses, so far we have so the balance is the trial balance. Admin expenses is the trial balance. So the admin expenses as the trial balance, we were given 127,713, 127,713, 127,713. We're done with the additional information. Okay, for now, that is what is affecting admin expenses on our adjustment. So that is what is affecting our admin expenses. If we come across any other adjustment, we can come back and adjust the admin expenses. So this one, they are saying that the proceeds should have been deducted. Sorry, they're saying that the gain or loss on disposal should have been recorded in admin. So if it's a loss on disposal, it's actually an expense. So if we have made a loss on disposal, it's adding to our expenses. So if it's a loss on disposal, it's increasing the expense. The loss on disposal is actually increasing the expense. If we come across other issues, we are going to bring them to this admin expense calculation as well. Then now let's move on and look at what else could be an issue. So we've dealt with the disposal. We have dealt with the disposal. Then we are told that the remaining investment in this classification had a fair value of 184 at 31 October 2023, which still needs to be recognized. Let's take note of this one, which still needs to be recognized. It means it has not been recognized. So investment through profit and loss, it means any gain or loss on the investment, we take it to profit and loss. If it's an investment through profit and loss, any gain or loss, we take it to income statement. So the gain or loss on investment, on fair value changes. So at the end of the year, if it's an investment through profit and loss, we check the gain or loss at the end of the year. Then that gain or loss is taken to the income statement. So we are comparing the carrying amount at the end of the year. You're comparing the carrying amount at the end of the year and the new value. They've said that the fair value is 184,300. So if the fair value is 184,300 and they have not calculated any gain or loss, we have to first of all work out how much was the gain or loss. So Pataka Tenge said the statement had also said that the proceeds have been deducted from the year-end balance. So they sold, but if you sell, what you are supposed to deduct is the carrying amount of the asset you have disposed. If you are to dispose an asset, in the asset account, if it's at NBV, you record the carrying amount of the asset disposed. But in this case, they are saying they removed the disposal instead. The proceeds have been deducted. So the proceeds were less than the carrying amount. The asset had a carrying amount of 62, but they removed 59. So it means from the amount that they remove, so we need the carrying amount of the investment, of the remaining investment. So the carrying amount of the remaining investment, we are saying, if we go to the trial balance, the carrying amount of the investment is 178,400. 178,400. But from this 178,400, they have made an error whereby the investment that they sold, of course, it has been removed, but they removed 59 instead of 62, which is the carrying amount of the investment sold. So it means we need to remove the additional 3,000 here. Why? Because Pataka Tengesa, the investment, they had removed, Pataka Tengesa, the investment they had removed, supposed to be 3,000. So Pataka Tengesa, the investment, they had removed a lower amount than the actual amount. So this means the remaining investment has a carrying amount of 175,400. The remaining investment has a carrying amount of 175,400. But they have said that the fair value of this investment, the fair value at the end of the year, the fair value of this investment at the year end, we were given as the fair value given is 184,300. 184,300. So the fair value is 184,300. Meaning what? If it was 175,400, but now Yapa 184,300, it means there is a gain. There is a gain in investment. How much is the gain? This minus that. So there's gain in investment. Gain on investment. Gain on investment, where do we put this one? It's an income. The gain on investment is an income. So our gain on investment is actually an income. So let's, so the gain on investment is an income. Do we have any other incomes here? There's other incomes. We have other incomes here. So in the trial balance, we are given other incomes. Incomes have a credit balance. So we have other incomes, 15,151. So it means for other incomes, for investment income, we can add it after the operating profit. So let's work out, let's remove the expenses, then we add the investment income later on. Or for now, let's just include it. Sorry, I need to pull this down. Please, the reason why you should practice more on this platform is you need to get used to these functions, because in the exam, it might be a disaster, and you end up failing to go back. So we said we have investment income, but let me put it after the expenses. So the investment income. So for investment income, there was investment income given 15,151 plus the investment income we've calculated 8.9. So income is positive. So that's 15,151 plus 8.9. So let's go back to that additional information. Any gain or loss on revaluation should be recorded in other incomes. So I think that is what we've done, because there was a gain in investment. So even without using that statement, if it's fair value through profit and loss, it means the gains, we take them to other incomes. I think item 3, we have looked at it. Now let's look at item number 4. The fair value through other comprehensive income. That's another investment. Fair value through other comprehensive income. So for the fair value through other comprehensive income, what are they saying? So here is it is a carrying amount of 120,000. So they are saying the fair value through other comprehensive income. What does it mean? Gains are taken to other comprehensive income. So if it's fair value through other comprehensive income, the gains are taken to other comprehensive income. And also, if you still remember when we did financial instruments, the costs of the investment are capitalized. The cost, any additional cost of the investment, they are capitalized. If it's the fair value through profit and loss, the transaction costs, these ones are expensed. But for fair value through other comprehensive income, the costs are capitalized. So I'm saying that because I'm seeing the cost here. The fair value through other comprehensive income investment involves a purchase made during the year. The cost of the 8,000 associated with this purchase were charged to admin. So that is contradicting with the rule. They charged the cost to admin, but it's fair value through other comprehensive income. So for fair value through other comprehensive income, the costs should be charged to, should be capitalized rather, not being charged to admin expenses. So our admin expenses have to be adjusted. Let's go to our admin expenses calculation. I think there is need to make an adjustment here and just, or rather change this one to, instead of calling it investment, I would say admin expenses. So let's call that one admin expenses. So we have another additional item on the admin expenses. Okay, so let's move on. So there is the cost of investment there, which was expensed. Cost of investment. The cost of investment is not expensed if it is fair value through other comprehensive income. This one is capitalized, so it should be removed from the expenses, and then, oh, it's 8,000. Removed from the expenses and then capitalized. So let me just review. Do we have anything else that's for admin? Anywhere where it's written admin expenses, you can just review. Item number 5, decision land and buildings. No. Item number 6, that's about shares. Item number 7. So I don't think there is anything else affecting the admin expenses. So for now, let's just deal with this one. So let's go and make that amendment. Okay, let's move. So admin expenses at 31 October 2023, the fair value of the fair value through other comprehensive income investment was that, which is still to be recognized. So the fair value is still to be recognized. But for this one, remember, it's not entered in the income statement, but it's entered to other comprehensive income. So let's calculate the fair value, but we are not going to take it to the income section. We'll put it to the other comprehensive income section below the income statement. So you can calculate the fair value changes. That is, we can just indicate which fair value is this one. So this is fair value through other comprehensive income. So for this one, I think that was the only information given. So we can compare the fair value we have been given in the trial balance, which is 120,000. So fair value as the trial balance is the trial balance. These are just workings. What about the narration? So fair value as the trial balance, that's 120,000. Then the year-end balance, that's the fair value. So, sorry, this one is the carrying amount. So it's the carrying amount. Then the fair value at the end of the period. The fair value is given as, so the fair value is given as 124,750. So there is again a fair value gain. So taken to OCI. So this one is taken to OCI. Why? Because it's fair value through other comprehensive income. So, oh, by the way, I'm remembering something. We said the 8,000 has to be removed from, the 8,000 has to be removed from admin. And what do we do with it? If it's the fair value through other comprehensive income, it's supposed to be capitalized. So it was supposed to be added to the amount in the trial balance. So we are removing the 8,000 and we are adding it here. So we can just, so this becomes 128. Because it has been removed from the profit and loss, it's then added to the statement of financial position. So in fact, there is a loss now. Because that 8,000 was supposed to be capitalized. So we have removed it from the profit and loss. Now we have, so the double entry is to remove it from the profit and loss from the expenses and we capitalize it. So let's move on. Item number 5. So this fair value will deal with it. Remember, tags with the other comprehensive income section. So far, where are we? Let's just go with the expenses. Do we have any other expenses besides the admin expenses? We have the distribution costs. So from the admin, we have the distribution expenses. The distribution expenses, let's check, do we have any item so far? We have not made anything to do with the distribution. So on 5, 6, 7, anything to do with distribution expenses, has made a decision to measure land and buildings fair value. The fair value of the land and the fair value of the building was 700. No adjustment has been made to reflect the revaluation. The share capital, those are shares, they don't affect distribution unless if there was an error made where it was recorded. No. On 1 September, the company declared a dividend. Dividends are not removed direct from the income statement. So the distribution expenses, for now, let's just take them as they are given. So the distribution expenses, 11611. So that's 116,166. So we get our operating expenses, our operating profit. Get our operating profit. So as the gross profit, you deduct the expenses. So the other incomes, you can add them on their own. So now we can add the investment income, the other incomes. So we can call them other incomes. The investment income was said to be added to other incomes. So from the other incomes, let's check, do we have anything else? The land and buildings, the investment, share capital, share premium, revaluation, retained earnings. Revenue is the only one that goes to the profit and loss there, cost of sales, profit and loss, distribution, profit and loss, admin, profit and loss, other incomes, we've included that. Then we have the tax. The tax, we remove it after the other incomes. So let's just go to the additional information and check if anything is affecting the income statement. So Gilbertra has made a decision to measure land and buildings at fair value for the first time. So let's say if you're using Excel, the good part about Excel is if you realize maybe you've made an error here, if you make an adjustment there, it can change everything. So if provided you realize there is something you missed, you can just make the adjustment. It will change everything if you have been using the functions. Then let's move. So Gilbertra Company has made a decision to measure the land and buildings at fair value for the first time. At 31, the fair value of the land and buildings was that, and the fair value of was that. No adjustment has been made to reflect the revaluation on the deferred tax. Okay, so let's calculate the revaluation here. So land and buildings have been revalued, but remember, if there's a revaluation gain, that's going to other comprehensive income. So revaluation of the land and buildings. So the revaluation of land and buildings. So the question is saying that the buildings have been, on that one, the fair value of the land was it is 1 million. Let's go and check how much was the carrying amount of the land. The land was at a carrying amount of 800. So this one, we can actually tell there's a gain on revaluation of land. So that's from 800,000 to 1 million, that's 200,000. So there's gain on revaluation of land. Then let's check, it was land and buildings. For buildings, the fair value was 700. If you go and check how much was the value for the buildings. So it was also a gain. So gain in revaluation. Oh, what happened there? Oh, that's not the one. This is now question 2. Just a moment. So gain on revaluation of land. Then we have also the buildings. Gain on revaluation of buildings. So the gain on revaluation for buildings, the buildings are now worth 700,000, 7,123,123 minus they had a carrying amount of 476,000. There's something I need to demonstrate there. So there's the issue of they've talked about the deferred tax. So overall, there is a gain on revaluation. So the gain on revaluation is 424. The gain on revaluation, when we are now taking it to, the gain on revaluation is taken to other comprehensive income. The gain on revaluation is not taken to profit and loss, it's taken to other comprehensive income. But if there is deferred tax, you take the gain less or net of deferred tax. So the gain that you take to other comprehensive income is net of deferred tax. So the deferred tax will say to be at 21%. I think we missed that one in the classes. So that's if you are removing, or you can just say that's minus 21% of 424. Yo. So the net amount is then what you take. Again, this one is not going to the profit and loss, it's going to the other comprehensive income. So item number, we're done with item number 5. It's not affecting the profit and loss. Then item number 6, the share capital comprises of, I think, since the question had said we should calculate the earnings per share and the statement of changes in equity, the movement in shares affects the statement of changes in equity. So I don't think item 6 also affects our income statement because shares are not paid through the income statement. Then the company declared, so I think we're done with the items that affect the income statement. So after that, then you subtract taxation. Remember that taxation that we left out was 428,000. So this one, the amount that we get is the profit for the year. Profit for the year. Then after the profit for the year, so after the profit for the year, you then come to the other comprehensive income. So for the other comprehensive income, there was gain on revaluation. There was gain on revaluation, and I think this one we had flagged it. Which one was it as well? Oh, this one, OCI. So gain on revaluation, 3, you can just say gain on revaluation, you can just say equals that. Then also we have the loss on fair value, changes. So we said if it's through OCI, the gain or losses are taken to OCI. If it's through profit and loss, the gain or losses are taken to profit and loss. Okay, so we're done with the income statement. Let me just try and figure out what I... Yes, I won. So let's continue. So I was trying to figure out how to remove those decimals. Now let's get to the second part of the question. So the second part of the question is saying, prepare the statement of changes in equity. Statement of changes in equity. So the statement of changes in equity. So for the statement of changes in equity, we are looking at the movement in share capital and reserves. So for our statement of changes in equity is the movement in the share capital and reserves. So the first thing to start with is the reserves that we had, the share capital and reserves that we had on the question. So we leave the column for details, then Let's just go to the trial balance and have our, so land, buildings, no investment, no. So we have the share capital. So we have the share capital. Let's just say, shorten that. So besides the share capital, we are given the share premium. It's a reserve. So if the share premium, so besides the share premium, we have revaluation. Revaluation, it's a reserve. Besides the revaluation, we have retained earnings. So revenue, we no longer have reserves. So let's have the opening balance. Balance PD. So the opening balances for the share capital, we have 900,000. For the share premium, 500,000. Revaluation, 32,514. Retained earnings, 436,607. Then after that, the next thing is to consider what is it that resulted in the movement of shares. So did we make any issue of shares? So if we issued shares, it's going to result in more share capital. And if the shares were issued at a premium, also share premium. So let's check. This is, I think, where those issues to do with shares come into play, item 6 and 7. Share capital at 1 November 20X2 comprised of 180,000 ordinary shares of 50 cents each. So I think that confirms the 90,000. Sorry, it's 1,800,000. That confirms the 900,000 because 1.8 times 50 cents, it's 900,000. So on 1 Feb, made 145 rights issue for dollar per share. So there was a premium of 50 cents. So the market price of the existing shares prior to the rights issue was $60. So yes, it's a rights issue. They reduced the price from $60 to $1. So they issued 145. So we are told that we had 180,000, so we can go to, this is now working number, I lost track now. So we can just indicate here, issue of shares. So for our issue of shares, we had a rights issue. So it was 145, 1/5 of the shares that were there, 1,800,000. So how many shares did we issue? That's 1/5 times 1,800,000. So 360,000 are the shares we issued. But of these shares, we have the share capital, we have the amount going to the share capital, and we have the amount going to the share premium. The 360 is the number of shares. So we're told each share was of 50 cents and it was sold for $1. It means the premium was also 50 cents. So you're taking the 50 cents to share capital and the 50 cents to share premium. So without delaying time, it's simply half of this. So a half goes to the share capital, a half goes to the share premium. So here we're going to say issue of shares. So the shares increased by 180. That's the value. The share premium also increased by 180. So that's for item number 6. No adjustments has been made. So that's confirming again. So even if they had not said that, because the opening balance is saying we have 1.8 million shares of 50 cents. So that would be 900,000. So it also shows we have not yet added the new issue. Then on 1 September 2023, the company declared a final ordinary dividend of 10 cents per share to all existing shareholders. This was paid on 30 September 2023 and was recognized in the suspense account. Good. So if they had just stated that the company declared dividends are not entered in the statement of changes in equity, but the dividends paid. So they declared and paid them in September. The company, what's our dates here? September, October. So this took place in September before the year end. If the payment was after the year end, we wouldn't include it in the statement of changes in equity. So the dividend paid, we are going to remove it from the retained earnings, not from the income statement. So let's move to the dividend paid. We remove it from the retained earnings. And how much is it for the dividend paid? Remember, so for the dividend paid, all shares, all existing shareholders. So they said all existing shareholders are getting the dividend. So it's 10 cents. How much are the existing shareholders here? It's per share, not the value of the shares. It's 10 cents per what? Per share. So we originally started with, or we can just say, yes, we started with 1.8 and we added 360,000 shares. So now the number of shares that we have the number of shares is this. So the dividend paid is 10 cents. And it's a payment. Let's put that as a negative. Please, in the exam, try to move fast. So that's the dividends paid. Then, besides the dividends paid, what else affects the statement of changes in equity? So the statement of changes in equity can be affected by the movement, or we have the profit for the year. Before I forget, we have also the profit for the year. The amount from the profit and loss is taken to the statement of changes in equity. So the profit for the year. So the profit for the year, it increases the retained earnings. Which one are we taking? Is the profit before? We're not taking the profit after the changes in equity, but we want the profit before. So the profit we are taking is this one. Okay, so let's move. So after the profit for the year, what else affects the statement of changes in equity? I think we were told about the revaluation. So let's look at the revaluation. So we can have so for revaluation, there was a gain. So we had a gain for the assets. Well, let's just take the net amount. We took to the OCI. Oh. Then we're done with the statement of changes in equity. We then add up to get your totals. Sorry, my mouse is okay. Let's move on to the last part of the calculation, which was saying, let's move to the last calculation, which was then saying calculate the earnings per share. So restate, so that's part C. So you should also mention this is part B. as EPS. So for calculating the EPS, restate the basic EPS at 31 October 20X2 to take into account the rights issue made during the year end. So if you are restating the basic EPS, so the restated EPS is equals to, you just take the earnings per share times the bonus fraction. So the earnings per share times the bonus fraction. The earnings per share for the previous period times the bonus fraction. So the bonus fraction for rights issue, you say the theoretical X rights price. So we're saying the theoretical X rights price over the market price. But no need to write the formulas in the exam. So like for the EPS and the bonus fraction. So let's start by calculating the bonus fraction because that is the important calculation. So for the bonus fraction, we need the theoretical X rights price. So theoretical X rights price. You need a theoretical X rights price. So for the theoretical X rights price, we say before the bonus shares, one share was going for $60. So 5 for every, the question is saying 1 for every 5. It means if you had 5 shares, which you bought at the normal price of $60, which is 5 times if you have 5 shares, you'll be given 1 more share. So 1 for every 5. But this share, you'll be buying it as $. The rights issue was at $. So it means in total, you'll be having 6 shares. In total, you'll be having 6 shares. And you have bought them, you would have bought them at a total price of 9. You'd have bought them at a total price of 9. So the theoretical X rights price becomes the $9 over 6. So the average price of the shares, so it's 9 over 6, which is $50. So the bonus fraction so for the bonus fraction, we are saying $50 over the market price, $60. So now we want the restated EPS. So for the restated EPS, we look at what was the earnings for the last year. Were we told anything about the earnings per share? What was the question? Restate, there is a statement above here. Giumbata reported the basic earnings per share for 31 October 2022, that's last year, of 20 cents. So you take that earnings, the basic earnings per share, here 20 cents, you multiply it by the bonus fraction. So is issue, it could be a bonus issue or a rights issue. The restated, you take the previous earnings per share before the rights issue or bonus issue, then you multiply by the bonus fraction. So our restated earnings per share would be, these are cents, so 18.75 cents. 18.75 cents, or that's can round off to 19 cents. That should be rounded off to 19 cents. Okay, time is not on our side. Let's move to the other question that I said I wanted us to look at. I want us to look at again. So this one is on consolidation. So we have recapped published accounts. Now let's look at consolidation. So for consolidation, the question is saying prepare the consolidated statement of financial position of Paisley Group. So that's from the March-June 2024. As you can see, these are past exam questions, meaning exam issues. So please, and I'm hoping that since I have been always singing, that you practice. These are things that you have already been doing. So the consolidated statement of financial position. So if you are preparing the consolidated statement of financial position, let's just go through the additional information so that we have a feel of what we'll be facing. So the fair value of, starting from here. On 1 January 20X9, Paisley Company paid 100 million in cash to acquire 80% of Scottish Company. The individual's financial statements for Paisley Company and Scottish Company at 31 December are as follows. So we have Paisley acquiring Scottish. So this is a group. Paisley is acquiring Scottish in order for them to form a group. So if it's 80%, this gives Paisley the right to call themselves a parent. So let's move on. Besides that, what else are we told? The fair value of Scottish net assets were equal to their carrying amount, with the exception of its head office. This had a fair value of 12 million in excess of its carrying amount. This will affect our goodwill calculation. At the date of acquisition, this had a remaining useful life of 10 years. So if the fair value on the date of acquisition is different from the carrying amount, it will affect, in the balance sheet, it will affect the non-current asset figure and the goodwill calculation figure. So on 1 July 20X9, Paisley Company also acquired 40% of Angus. So 40%, it means that firm is our associate. So if you have acquired 40%, you have no controlling interest. So that's your associate. So for associate, we don't consolidate. We just account for the investment in associate. So Paisley paid 30 million cash. In addition to this, Paisley issued to the previous owners of Angus 30 million shares in Paisley which had a market value of 230, that would contribute to the amount we paid. So if you pay in cash and you give also shares, that would mean Maria Maga Badara Wenzira as well, based on the fair value of my shares at Taraba. So we gave them shares for 30 million shares, which had a market value of 230. So that would be 30 times 230. That would also add to the amount we paid them. So let's move on. The total consideration exceeds the group's share of Angus net assets. Firstly, company has only recorded the cash consideration. So it means in our books, my shares, they are going to be affected. Okay, let's move on. Scottish company made a loss of 10 million for the year ended 31 December. So when did we acquire, by the way? Just a moment, let me respond. Okay, sorry for the disturbance. Let's proceed. Let's proceed. So I was going through the additional information. So, okay, I'd gone back to just check the date. So 1 July, that's when accusation took place. So we are told by December, that's about 6 months down the line after accusation, the company had a loss. So we bought the company and that year it had a loss. Then we are told again that Paisley Company and Scottish both hold other equity investments. No election has been made to classify them as fair value through other comprehensive income. So we have not elected to classify these investments as through OCI. These have increased from 15 to by 15 million and 3 million respectively. But no entries have been made to reflect this. All these gains have been made in the post-accusation period. Okay. Scottish company and English company have both sold to Paisley for years. None of these goods have, so that those are intra-group sales. None of these goods remained in their group at 31 December. So there isn't any intra-group calculation we are doing here because none of the goods are in inventory within the group. Firstly, company's financial statement shows 5 million payables to Scottish. So Yes, that one we write it off, intra-group payables. We can't be owing each other. This disagreed with the amount received in the financial statement by Scottish of 2 million payment made to, so there's a payment which has been made. Yaita kuti chikwere chiri kutaurwa ne Scottish ne chiri kutaurwa ne Paisley zvisiyane, that's the due to cash in transit. Paisley values of non-controlling interest it's 29 million. So we've gone through the additional information. It's wise to quickly go through it, even if you're doing the published accounts, the question we're doing, so that at least you quickly pick. Like parachutama admin expenses, you could, if we had gone through the items, we could quickly pick that there was also another additional information which was to do with admin expenses. But this is to be done very fast. Okay, so the first calculation that we can do here, working number one. Maybe let me just start with workings. Working one, for consolidated statement of financial position, always we start with goodwill. So goodwill, or it could be a purchase bargain. It's likely it can take place that a purchase bargain can also arise, especially if this company, in this case, we are being told, it is actually given as a loss. We could have bought it at a bargain price. So the goodwill will start with the purchase consideration, and this is calculated only for the subsidiary, which is Scottish. So we bought at 100 million. So the purchase consideration was 100 million. So let's just slash the 3 zeros. So that's 100 million. I've just put the 100,000. So we have the purchase consideration. Scottish given any shares? So I think we are just told the straight amount of how much was paid. So we are not given anything else. Only Anguish was the one given shares. So from there we have fair value of NCI on the date of acquisition. So we have fair value of NCI on the date of acquisition. It was given at the end. That's the 29 million then. We've slashed 3 zeros, remember? So from there, you less the net assets of subsidiary. So the net assets of subsidiary, you can start with the share capital of Scottish. The share capital of Scottish, if we go up, it's 40,000. Did they slash the zeros? Yes. Then besides the share capital, we have retained earnings, but we want at the date of acquisition. So the retained earnings we are given is at the end of the year. 81.7 is at the end of the year. So on the date of acquisition, we are going to say 81.7 minus the retained earnings we have made together, because we want the retained earnings at the date of acquisition. So there was a statement saying Scottish made a loss of 10 million for the year up to 31 December 20X9. So if Scottish made a loss So it's actually minus. So that would be a plus. So we're supposed to subtract the profit at now. So in this case, we actually told Guti after. So the quickest way of getting the profit now is to say profit ilipo at the end of the year, the retained profit at the end of the year, less yatakaita tiri pamwe chete. So tiri pamwe chete, we did not make a profit, we made a loss of how much? The 10 million is for the whole year. We bought this business in July. So it means we have been together for half of the year. So we are only going to account for half of the year's loss. So this would be, you'd get 86.7. So we have just accounted for the loss we have made Tripamwichet. So this would give us the retained earnings that that they had on the date of acquisition. Then from there, we are also told of the fair value adjustment. So for the fair value adjustment, we are told that the fair value of net assets were equal to their carrying amount, the item number one, except the head office, that's the building, which had a fair value of, it's an asset, which had a fair value of 12 million in excess of its carrying amount. So fair value adjustment in excess is positive. I think that's all. There is an option I'm looking for. Just a moment, let me see if I were to get it. Okay, it's taking ages. Let's just do without that. So it's a negative. A negative is a purchase bargain. A negative is a purchase bargain. So if it's a purchase bargain, it's a good thing. We got a purchase bargain so that I don't know how was good. We are used to a goodwill situation. Oh, what happened here? Just a moment. Let me try to. Okay, let's proceed. So there's a purchase bargain. After the purchase bargain, I'm sure even if we don't get to, because of time, maybe if we don't get to do the statement of financial position, but if we can do all the workings, you can be able to then incorporate them into the statement of financial position. So the goodwill, we have done that. So this one is not going to be treated as a non-current asset because this one is a purchase bargain. So working two, let's work out retained earnings. That's another key working. So another key calculation is retained earnings. So for retained earnings, I normally use my table with the parent and subsidiary. So we have the parent and we have the sub. So we have the retained earnings of the parent and we have the retained earnings of the sub. So we start with the ones given. At reporting date. At reporting date, so at reporting date, we were given for the parent, it's 214,300. For the subsidiary, 81,700. Then at acquisition, so at acquisition from the side of the subsidiary, we less the retained earnings at acquisition is the same amount here. Let's move on. Then from there, we move on to if there is a purchase bargain. A purchase bargain, it's a benefit to the parent. It's added to the retained earnings of the parent. If you buy at a bargain, it's a profit you have made. That is added to the retained earnings of the parent. That's a key adjustment I wanted us to talk about here. So this one is not supposed to be a negative. So a purchase bargain is added to the retained earnings of the parent. Then from there, we move on. If we had sold to each other, this is where we would put the PAP. But the question was saying we have not sold to each other. So the question had said there was no closing units. All the goods were no longer within the group. So PAP is calculated provided the goods are still within the group. So I'm just thinking of what else could go into our calculation. Okay, we also have depreciation on fair value adjustment. So the depreciation on the fair value adjustment, it tends to reduce the profit of the subsidiary. So that additional, it means when we calculated the depreciation for the subsidiary, it was understated because Padagazo Chekama assets a subsidiary. We realized that they had a higher value than the reported value. So depreciation was undercalculated. So we adjust for depreciation from that date onwards. From the date of the fair value adjustment onward. So it means there is additional depreciation, which needs to be calculated for the 12 million fair value adjustment. So we added my assets. We added value my assets. We also need to counter add the value of depreciation. Because once we have increased the assets, the expense for depreciation is also likely to increase. So we are going to say this one, it was said to be of 12 million spread over a period of 10 years. So I would say 12 million divided by 10, which would give us, that's 12 million divided by 10, it would be 1.2. But when we made the fair value adjustment, it was halfway through the year. It was in July. So if it was for the whole year, it would be 1.2 million. But since this is half of the year, we are supposed to put half of the amount. So the fair value adjustment, well, towards it, of course, it will add the value of the asset, but also depreciation is going to increase. So I think we have, let's just go, and there was a statement which was saying, which was talking about the fair. Scottish and English have both sold goods to Paisley. For many, none of these goods remained in the inventory. Not this one. This item number 4. Paisley Company and Scottish both hold other equity investments. No election has been made to classify them as through other comprehensive income. So if we have not elected to classify the investment, you have not elected to classify the investment as through OCI. It means by default, the investment will be through profit and loss, meaning the gains and losses are taken to the profit and loss. So if, what is the benefit to, why would someone elect the investment put in this through other comprehensive income? It means it reduces their tax. But if the investment is classified as through profit and loss, it will increase the amount that they are supposed to be taxed. So in this case, the investment has not been classified through OCI. It means the gains are taken to profit and loss. So we can say fair value gain. Where are the fair value gain? So the fair value gain, we were told that the parent, which is P, at 31 December, the investment had gained by 15 and 3 million. So we have the gain in investment for the parent, we add. For the subsidiary, we are adding as well. So if the investment was through OCI, we wouldn't add the gain in investment to the retained earnings of the parent and sub. So I think that is the only adjustment that I think needs to be taken into account. So if there was PAP, remember, if there was PAP, it was to be also accounted for here. My mouse is acting up. Okay, then let's add up. So after that, you say share of subs profit. But in this case, it means the subsidiary made a loss. So share of loss. In other words, this means this is the loss that we made together. The adjustment we were making for the subsidiary is after Tabatana, did we make a profit or did we make a loss? So this is the loss we made together. So for the loss we made together, the parent has 80% share, so they'll get 80% share of that loss. So this becomes the group. This is what is transferred to the group. So that's the share of subs loss. So what would get there? This one, it would be our group profit. But there was also, if we did not invest in the associate, it means for retained earnings in the statement of financial position, we would take the 236,920. But since we've made an investment in an associate, we can also add the share of profit from associate. So the share of profit from associate. So the share of profit from associate, let's go and hear what the question was saying about the associate. We told about the associate's profit. So yes, I think where there was 10 million, they said Angus made a profit of 6 million. So the associate made a profit of 6 million. When did we buy the shares in associate? It's the same date, 1 July. So the share of profit we are going to put is the share of profit from about 40%, that's the first thing. The associate made a profit of 6 million, that's this other thing. Then the last thing is, it's now 6 months after we bought the associate. So we're not adding all the 40%, it's only for 6 months. We are only accounting for the 6 months here. So it means the consolidated retained earnings. So for our consolidated retained earnings, we are going to have, so this is our group of consolidated retained earnings. So that's our group retained earnings. That's the group retained earnings. So the other calculation besides the group retained earnings that might give you a challenge is calculating the investment in associate. So the investment, so calculating the investment in Angus. So calculating the investment in Angus. So for the investment in associate, if we're working out the investment in associate, the first thing to take note is how much did we pay? So you start with the cost of the investment. So how much did you pay? So if we go to the question, we acquired 40% and paid 30 million. So there was cash consideration. So for the investment, we paid a cash consideration of 30 million. Besides the cash consideration, we were told in addition to this, so we're told in addition to this, there was a share exchange. So share exchange. So in addition to this, there was a share exchange. And what was the nature of the share exchange here? We were told that 30 million shares for 230. So it's just the 30 million times 230. So 30 million, if we slash the 3 zeros, then times 232.3. So if you make an investment in an associate, that you equity account the investment in associate, meaning that the investment gains as a result of the profit that you make. And if the associate makes a loss, the investment drops in value. Then also, if you get a dividend, it reduces that investment. So if you are equity accounting for the investment, you start with the cost, then you add any profit from associate. Profit from associate. The profit is the same that we've added to the group. So the profit adds the value of the investment. Then if you are to receive any dividend, I did not come across anywhere where they were saying we received a dividend. So it means the investment in associate that they are going to account for is this. That's our investment in associate. Another key calculation that might be also important is calculating the, maybe let's say the PPE. Let's just quickly look at that, calculating the PPE. So if you're calculating the value of our PPE, we're at 215 for the parent. So for the PPE, we have for the parent, $215. Then we have the subsidiary, 87. Then we had fair value adjustment. So that fair value adjustment, if it's upward fair value adjustment, it increases the value of PPE. Then we less the additional depreciation. So the additional depreciation reduces the value of PPE. How much was our additional depreciation? 600. Okay, so I think for the other remaining areas, you can go and attempt and also look at the solution. By time now, they are closing where I am, so I need now to end the session. So hopefully you guys have been preparing, and